No, thank you so much, Dimitri. Thank you so much, everybody, for inviting us out here. Really been looking forward to it, and especially because it's like 105 in Texas right now. I've had several people ask about the cowboy hat for my cowboy economist stuff, and it is a royal pain to bring on an airplane with you, and apparently I learned to my shame that it's out of fashion. Melanie's school had a Christmas party in the stockyards in Fort Worth, and some guy mumbled as I went by, oh, hi, Pavlina. Some guy mumbled as I walked by, was that like a hat from the 80s? I was like, well, yeah. I mean, I didn't know that cowboy hats changed, but apparently, apparently they do. Now, it's interesting, I was listening to Rowan talk earlier about, priests as informers versus priests who have monopolies of information that they're keeping for themselves. And what I want to talk about today is what I have called the MMT as currency killer hypothesis, all right? This is what we hear from our detractors. And what I would really like to show you is what the priests who are holding their monopoly on knowledge, what they're not telling you, what the underlying assumptions are. And I want to arm you with the ability to, if you get stuck in an elevator with Larry Summers, first of all, just wait for the next elevator. But if you do get stuck in an elevator with him, then this is what you should say. And I have an example for you of how gloriously satisfying it is to face up to a neoclassical and know their own premises better than they do and have the person squirming about it. So we'll show you that here in just a second. Now, I don't know if you've heard, I was going to start this off with a slide of somebody making the sort of MMT as currency killer attack. And so I'm looking at all these attacks on MMT, right? And it reminded me of this, the idea that the longer an internet conversation goes on, the likelihood that somebody references Nazis approaches 1. Well, I didn't find that. I didn't find anybody comparing MMT to Nazis. I probably just didn't look hard enough. But I did find it's the most potentially damaging economic doctrine I've ever encountered, with the possible exception of communism. So I think it's a lot better than Nazi, but we may have to have our own law of some sort for MMT-oriented internet discussions. But I do have one for you. This person here says, well, sure, the government can't, default on the debt, but there's other ways of defaulting. Well, actually, there's not. But what this person says, if there's lots of inflation, that's kind of like defaulting. And if the currency, depreciates, that's kind of like defaulting. And so that's what I want to talk about right now. I want to talk about what is what is that argument? Where are they coming from? They're going to say, first of all, they're going to say MMT causes inflation. And then once you have the inflation, then that leads to currency depreciation. And the basic argument is, okay, let's say there's some crazy MMTer gets in charge. Stephanie Kelton's sitting there by the money printing machine, turning it over and over and over. And this person creates piles of new money because government deficit spending, there's no limit to it, and so this will cause inflation. And then here's the exchange rate part. The inflation then makes domestic goods and services less attractive to foreign buyers. This means nobody wants to buy our currency. I tell my students, when you're doing research and as soon as you find a web page that says buy gold on it, just go to another page. I mean, it's just not worth it. So, what I'm going to show, I forgot about I was a physics major for a whole 5 weeks, by the way, and we learned about this guy. And there's a fantastic quote from a conference he was at where he says that whether or not you can observe a thing depends on the theory you use. So if we're going to look at the MMT as currency killer view, we're going to know, well, what theory they're using. What are the foundations of this approach? They're coming up with the idea that there's going to be this catastrophic depreciation. And that's exactly what I'm going to do. The foundation of their attack starts with the equation of exchange, particularly as employed to argue that money growth leads to inflation, and then purchasing power parity. And what I'm going to argue is, with both of those, that foundation leads to this for the overall argument. Or, I just read something very exciting. Buzz Lightyear's new movie has been banned in the United Arab Emirates, and here he is right here, as it turns out. Here's Buzz Lightyear arguing with the people who say that MMT is going to cause a catastrophic depreciation. That's not how this works. It's not my slide. I know the grammar's wrong. All right, so I stole it. So here is the equation of exchange. And if you had an intro econ class, then you may have had to do this yourself. I used to teach it. Well, I still do, but as a means of saying it doesn't work that way. So, because it's so ingrained in people's minds, even without the equation being there. You print money, it causes inflation, right? So that seems to be a conventional wisdom. On the right-hand side, And what I'm going to do is I'm going to give you a couple examples, so don't worry too much if you don't follow right here. Well, it's simple math. On the right-hand side, we have the total dollar value of all transactions that took place in the economy. You know, the number of things that were produced multiplied by their average price level. On the left-hand side, you've got the money supply, and let's pretend that's just, you know, physical dollar bills. That'd be easier to think about. Physical dollar bills. How many of those there are? If this is going to be equal to the dollar value of the transactions, then we must use these dollar bills potentially more than once, and this is how many times each one is used. For example, if there are 50 things in our economy, each one selling at an average of $6, then there's $300 worth of transactions. But oh no, we only have $100 in the money supply. How could this possibly work? Well, as long as everyone uses each dollar bill an average of 3 times, then indeed, $300 of the transactions can be financed by just 100 $1 bills. And, you know, what if we go up to 100 goods and then we have 600, but it's still only $100? Well, if the velocity is 6, that works too. And just, you know, examples like that. And what the student gets out of this, I guess, is, I mean, it's just kind of interesting. I mean, if you're, you know, you're in an intro econ class, oh, have you ever seen "Where's George" stamped on a dollar bill? So that's kind of the idea here. There's this company, I don't know how they make any money, but you can buy, well, I'm just about to explain how they make their money. You buy something from them. You buy this stamp that says, "Where's George?" and you put it on a dollar bill, and then when somebody else gets the dollar bill, they look up the serial number, and they can see, oh, this was spent, you know, in Minneapolis, Minnesota. That's kind of neat. You know, you can see how the money moved around the country. I'm not sure what the deep economic lesson is there, but yeah, it's worth telling students that you don't need a single dollar bill for every transaction. And really, no economist disagrees with this. There was one guy, but he died. And so the equation itself is not really all that controversial. It's the assumptions about the individual variables. All right? So again, I'm trying to build up here to the MMT as currency killer, in the first stage of it being MMT is going to cause inflation. Milton Friedman would say that the velocity of money is constant. And it's constant because it has to do with people's habits and because it has to do with the structure of the financial institution. I mean, imagine that if it took a year for a check to clear, well, then the velocity of money would be extremely low. It would be a very long time before that same dollar bill got to be spent again. So he says, well, let's just say it's constant. It's affected by long-term factors. It doesn't change very quickly. Let's just assume it's constant. And then here's a favorite assumption of neoclassical economics. Let's assume we're already at full employment. This becomes sort of a long-run, you know, theory that in the long run, the neoclassicals are assuming that, well, we're going to get there anyway, so let's just pretend we're already there, all right? So we're going to assume then, from their perspective, that velocity and output, this is going to stay at 3, and that's going to stay at 200 because we're already at the full employment level of output, all right? Now we have our crazed MMT policymaker, and that person goes and doubles the money supply. What the hell, all right? And so what can change here? Well, V and Y can't change because our assumption is that they're constant. Our assumption is that the velocity is constant. Our assumption is that we're already at the full employment level of output. So those can't change. And we know that these two have to multiply out to the same thing, all right? So what's the only thing that can change? Oh my God, this MMT person has doubled the price level, all right? So we change the money supply. We double the money supply, and since by our monetarist assumptions, since velocity and output can't change, the only other thing we got left is the price level. So here we have, you know, this MMT policymaker tripling the money supply because the government can't default and so on, and all they've done is tripled the price level, and that really sucks. Now, so breaking their argument down, all right, breaking their argument down, it's based on 3 premises here, and another one that I have hidden that I want to bring up later that's really fun. And what I want to do is I'm going to go through each of those premises and say, well, how valid is that if we compare this to real world phenomena? First one is, of course, the MV equals PY. And then I told you, velocity stable, output constant, and therefore, if we increase the money supply, all it's going to do is increase the price level. All right, first one. Well, MV equals PY is really definitional because the way you come up with V is you simply take P times Y and divide by M. You cannot independently calculate V. All right, you can independently calculate the money supply, kind of, and there's been whole sessions on that. You can independently figure out what the level of output is and the price level, but you can't figure out V without those other three variables, so of course it works. It would be like if you were doing research on baseball and you're like, oh my God, I have found this incredible relationship in the real world. I have all these data between batting averages and numbers of hits and at bats. Well, of course you did, because that is the definition of batting average, right? So that's, so this is why it's like, okay, yeah, okay, whatever, all right, that one's okay. Velocity. There's lots of evidence that velocity doesn't stay constant. Guess what? It accelerates in expansions and decelerates in recessions, and it went way down after the financial crisis and way down after COVID. But here I am quoting something from 1959. It's a very famous piece, the Radcliffe Report, and I love the way they word it. I know. We have not made more use of this concept, velocity, because we cannot find any reason for supposing, or any experience in monetary history indicating, there is any limit to the velocity of circulation. It's a statistical concept that tells us nothing directly about the motivation that influences the level of total demand. So, no, I don't like that premise either. Right? I don't like the velocity as constant premise either. And probably a lot of us here would be against the Y is constant part. I don't know, I just gave you a chart from 1980 of US rates of GDP growth, real GDP growth. And of course that famous quote from Keynes, that in the long run we're all dead. But not everybody knows the context of that. I mean, because specifically what he's arguing is that when we say to ourselves, well, sure, but in the long run, in the long run it goes to full employment. In the long run we have balanced trade and so forth. He says, what we've basically done is said, you know what, I'm going to excuse myself from having to explain that at all. All right, I'm going to excuse myself from explaining that. We set for ourselves too useless, I don't even see what the quote is now. Too useless and, oh, that's all it says? I thought it was something else in there too. Oh, thank you, very good. It's my slide, so I haven't read it very well. And by the way, all right, so I want to tell you this too, because I give talks like Rotary Club and stuff like that, and sometimes when I'm attacking mainstream economics, I think to myself, they must think I'm an idiot, that I just don't understand mainstream economics, or that I'm somehow, lying or whatever. And so I've used this quote a lot, because here is Obama's former chair of the Council of Economic Advisors in an online encyclopedia about, this entry was about business cycles, and she says here, the second sentence, the prevailing view among economists, put neoclassical in front of that, is that there is a level of economic activity often referred to as full employment at which the economy could theoretically stay forever. All right? So this is an interventionist neoclassical economist. This is Barack Obama's neoclassical economist. She's like, well, it could stay there forever unless there's an external shock. It just takes care of itself, so don't worry about it. I have a colleague who read I wrote a paper on post-Keynesian economics for a neoclassical journal once. And the first thing I did was send it to other post-Keynesians. And I thought, well, that's dumb. Send it to a neoclassical, because they're the ones that are going to be reading it, and I want to know their questions. And so I sent it to a colleague, and really nice fella. In fact, he's been turned from the dark side very slowly here over the years. But he said, well, but surely the economy tends towards full employment because it's there sometimes. One of our daughters lives in Tucson, and sometimes it rains. But that doesn't mean that a lack of rain somehow causes rain, an equilibrium sense. And I don't know if you've ever seen this cartoon. I love this cartoon. You got these cave people here trying to get this fellow to the other side of the chasm. And I did not write this, and I really need to take the time to figure out the background of where this came from. But here's the end of it. And I got to tell you, I'm going to have stuff up here in a minute from neoclassical economists that basically say that. That say, well, it ought to work. I mean, our data don't show that it works, but it ought to work, so, we'll go on with that. So, thinking back on those three premises, the MV equals PY, okay, fair enough. Velocity is constant, no, it's not. Output is, constant at the full employment level, no, it's not. But, all right, I want to talk about something else here, all right? And let's go to the master himself, Friedman. What's the name of that article? The Optimum Quantity Theory of Money, something like that. And this is actually scanned from my copy from grad school, because I had to read it in grad school, and it's my underlining. And I pulled out three little passages here, because I want to talk about another problem with the MV equals PY theory. And that is this. Oh, and by the way, if you've heard people talk about helicopter money, but you never knew where it came from, this is where it came from. Right? Friedman is saying here, let us suppose, he set up the model and he said, basically MV equals PY, and he said, we're at full employment, and he said velocity is constant. Everybody has as much money as they want. So he's already set all that up. And he says, now let's say a helicopter flies over and drops an additional $1,000. So that's the increase in the money supply, all right? That's the increase in M. And they already had as much money as they wanted, though, all right? So the helicopter drop created what they call an excess supply of money, all right? An excess supply of money. And because this is money they didn't want to hold on to, they rushed off to the store to buy stuff, but there is no more stuff than before because we're already at full employment. So all they did was cause inflation. So this is kind of putting a story behind MV equals PY. When the M goes up and then the P goes up, what's happening? Well, it's like a helicopter drops money out. They didn't want the cash. They went and spent the cash. There was no more stuff, and they put up the prices. The problem is that the Fed can't give people more cash than they want, all right? If this is your story, if money supply is going to be, affected by the Fed and is going to be, increasing the money supply. If I'm the Fed and I want to increase the money supply, I'm going to buy, for example, I want to buy Treasury bills from you, right? So how can I give you more cash than you want? Except that you are willing to sell me a Treasury bill, all right? You have to have it has to be a voluntary, conscious transaction. You have to be willing to sell me a Treasury bill. I cannot drop money on you. That would be wonderful. We live near the Dallas Fed, so that would be nice. But that's not the way it works. If I'm going to increase the money supply, you must believe that you want this asset in your portfolio, right? And they can't do that, all right? And I don't remember who I read this from, but it has stuck with me for years. It might have been Basil Moore, I don't know. But it said money supply is like, money is like a haircut, right? It cannot exist without the voluntary, conscious cooperation of another individual. So you can't have an excess supply of haircuts. If you're a barber and it's the Friday before a big holiday weekend and you're thinking, man, there's going to be a big rush, I should make some haircuts before people get here. That way I'll be able to, meet the rush. Now, if you're a baker, you can do that with cupcakes, all right? You can say, well, there's going to be a big rush for cupcakes, so I'll make some extra ones, and then that way when the people show up, I'll have extra cupcakes. And you can also have an excess supply of cupcakes, all right? But you can't have an excess supply of haircuts. You know who ruined that example for me? Mitt Romney. Because I don't know if you remember when he was running, he held down some unpopular kid in school and shaved his head. All right, so omitting Mitt Romney. All right, haircuts are entirely. He said he felt really bad about it. Omitting the Mitt Romney, you can't do that. Now, okay, I promised you. My life has gone downhill since this next exchange I'm going to show you, because this was the. No offense. This was, my wife's right over there. This was the high point of my career. This is back when on my Forbes blog I actually bothered to answer people, and I answered everybody. No, my parents were married when I was born, stuff like that. So, and this person, I had done my post on money growth leads to inflation, which now, thank you very much, Real Progressives, it's hosted there because these things on Forbes apparently expire after 10 years, right? So it's money growth doesn't cause inflation or something like that. And so a monetarist commented, a guy who had his PhD from the University of Chicago, where Friedman was, and who ran some sort of international consulting firm or something like that. And I'm going to call him Marcus the Monetarist because his name was Marcus and he was a monetarist. And I also, I want to point, my maid Melanie and my daughter Alex was home, and I made them watch this already. And Alex said, Dad, there's misspellings in the thing you're about to show on the part of Marcus the Monetarist, and it's going to make it look like you're trying to make him look bad. It's like, I wasn't. I just copied and pasted. So forgive Marcus for the misspellings. He was in a hurry. He was also flustered, as you'll see here. But Alex has a law degree, so I thought I should take her advice and mention this real quick. And so here we go. So, and we'd already been talking about this for a few minutes. I said that, the problem is that none of that addresses the fundamental fact that one cannot increase the money supply above money demand. And look, he even uses an exclamation point here. If you cannot increase the money supply above the money demand, you would never have inflation. So, I mean, it's not, again, sometimes I think to myself, well, maybe they don't really believe this. But there it is. I mean, if you can't increase the money supply above money demand, because money is always and everywhere a monetary phenomenon, according to Friedman. And I said, okay, all right, fair enough. Explain how this happens in the real world. How do they increase the supply of money? And he says, well, and this is the answer. That's not really economics, all right? Why during inflation? I don't know, but just tell me the mechanism, all right? So I ask again, all right. Oh, and he's already done, it's like putting logs in a fireplace. Like, no, it's not like putting logs in a fireplace. It's just like buying treasury bills. It's exactly like that. And so, or helicopter, and he says, well, think about a big harvest of apples. Well, for God's sake, this should be so fundamental to a monetarist economist. What is the mechanism by which the Fed increases the money supply above money demand? And then when you think about this, you think to yourself, oh, okay, well, let's get Kramer on there real quick. So why would somebody believe that? Well, all these really questionable assumptions, all I can think is that they already have this kind of bias towards government bad, all right? So I hope I'm not on a list now, because I just searched for government bad, and this is really a book by somebody here. I don't suggest buying it. And all I can think is they already wanted to believe that to start with. Otherwise, I can't imagine, why you would do this. And also, this didn't strike me till several years ago, because you get taught all this. I mean, I showed you that was my grad school article. I had to read Friedman. Oh my God, the helicopter's engaging in fiscal policy. It's not engaging in monetary policy. It's like a $1,200 check is what they did. It was like a $1,200 check during COVID. They dropped extra money out. If that helicopter was really doing monetary policy, it would be like in The Grinch Who Stole Christmas, when the Grinch comes into people's houses and steals all their Christmas presents, except this time they go in and steal their treasury bills, but replace them with an equivalent value of cash. And then people would wake up in the morning and say, crap, this is not the portfolio of assets I wanted. Now I've got more cash than I wanted. But do they go to Target to buy a big screen TV? No, they go back to the financial market. So this is going to be a financial market adjustment. So for that matter, the helicopter is engaging in fiscal and not monetary policy. All right. Well, let's do something now that they don't do for us. Let's be charitable. Let's say, yeah, but all right, your monetary policy mechanism is all screwed up, but fiscal policy can cause inflation. And that's what we're talking about, it's fiscal policy, so that could cause inflation. It's not the printing of the money. If we're already at full employment, World War II, U.S. is at less than 2% unemployment, and we're still stimulating the economy. This is why we raised taxes, why we had bond drives, and why we had wage and price control. So, hey, monetarists and neoclassicals, stop doing the MV equals PY thing. Let me do you a favor, all right? Let me tell you should be talking about fiscal policy and not monetary policy, because that could potentially cause inflation. Except, oh, sorry, I'm one behind. Except, here we go. The whole idea behind what we're talking about is, what if there was a gas station where you could get free air for your tires? In fact, there is near our house. And near that gas station, we always see tons of cars stranded in the parking lot because people just kept putting in air until their tires exploded. No, of course not. Just because there was no limit to how much air they could get for free didn't mean like, oh my God, this is awesome, and then the tire explodes. There's a different goal now. You look on the inside of your car door and it says 32 pounds per square inch, and you're like, okay, and I'm watching the thing back here as I put the air in. I don't keep on going just because it's free. In fact, there's a place where it's not free near us where you can actually plug in 32 and go over and it just turns itself off. That's a job program, all right? That turns itself off. So, yeah, you're right. If you continue to stimulate the macroeconomy past full employment, but remember they're already assuming full employment, so any stimulation, I guess, is past full employment, then that would be inflationary, and that's why we don't do it, all right? So there's part one of the foundation. There's the equation of exchange, which I spent a long time on, but eventually decided to be charitable and say, oh, you don't have to think about equation of exchange anymore, neoclassicals. We'll let you slide with fiscal policy can cause inflation. Okay, yeah, it can, but that's why we've already thought about that. Right? Now, the second half, and my area is actually exchange rates, and so this is well, I have a lot to say. All right. The second part of the argument is, right, the first part is that MMT policies will cause inflation. And the second part is that inflation will then cause currency depreciation. All right, let's say there's inflation from, let's grant the first part. Well, I've already said I don't think that makes sense, but let's grant the first part there's inflation. Does inflation necessarily cause the currency to depreciate? The specific theory that they're using here is purchasing power parity. Don't worry about figuring that out. I got a bunch of examples coming up here. But if you've heard of the Big Mac Index in The Economist, that's what it's based on. What they're doing is they're looking at what is the price of a Big Mac in London versus the price of a Big Mac in New York once you take into account exchange rate differences. And if it's still more expensive in London, once you measure them both in the same currency, oh, well, then the pound is overvalued. All right, and so we should expect the pound to depreciate. Oh, I'm giving away too much of the story. Hang on. All right, now, I was lazy and used the same slides I did for an Australian MMT presentation I did, so that's why we have Brisbane and Melbourne. But I'm going to start off with just purely domestic stuff to explain where neoclassicals are coming from with inflation causes currency depreciation. And let's say that you find out that a loaf of bread in Brisbane is $3, you know, $3 Australian dollars, and in Melbourne it's $4. Let's assume no transportation costs because it is an 18-hour drive from Melbourne to Brisbane, but no transportation costs. What are you going to do? You're going to buy up the bread in Brisbane and then, you know, drive down to Melbourne and set up a little, you know, briefcase or whatever on the corner and start selling bread. And it's going to drive up the bread price in Brisbane and drive it down in Melbourne until voila, the arbitrage opportunity is gone. All right, but now let's make, and it's the same basic idea, except now let's do Brisbane and Shanghai. All right. And let's say that we find out that a loaf of bread in Brisbane is 3 Australian dollars and 12 yuan in Shanghai. Well, obviously we have a piece of information missing. And so let's say that for every 1 Australian dollar, you can get 5 yuan. And now let's translate them both into dollars, Australian dollars. Aha! In Shanghai, bread's actually cheaper. Or we can do it, of course, in yuan. Either way, the bread in Shanghai is cheaper than it is in Brisbane. So now we got the same situation, except we have to go across an ocean as well. And this sets into motion people buying up the bread in Shanghai and then selling it in Brisbane. Now, this is bad for Australia, right? I mean, what if this is, that's really the law of one price. It's not purchasing power parity. Law of one price is like every good should be exactly the same. Purchasing power parity is on average, they should all be the same. So let's say that that's representative of other prices in Australia and China. Then, oh no, they have a trade deficit. Now this is another place where, you know, like the full employment assumption? That if we have something threatening the economy, well, that's okay, the economy fixes itself. Well, this is going to fix itself, all right? This is going to fix itself now. This is glorious how the free market works. Australia has a trade deficit. This could potentially be draining demand from the Australian economy, but that's okay. Because what's going to happen is, don't pay any attention to the ones covered up in yellow. I haven't translated those yet. But everyone's going to be buying the yuan in order to buy their bread, and no one's going to be buying the Australian dollar. So the Australian dollar will depreciate. Look at what it was before. You got 5 for 1 Australian dollar before. Now you can only get 4. So the yuan appreciated, the Australian dollar depreciated, and let's see what happens here. Oh, and by the way, I could of course change the own prices of bread, but I left those alone because it's a story about exchange rates. But it is possible that, you know, the neoclassicals would say, well, maybe these will change some too, but I want someone to talk about exchange rates here. And so now once they're both translated in the same currency, then we have the exact same price, and Australia has a trade balance, and the free market has fixed everything, all right? So the trade deficits go away just like unemployment goes away by itself. Now, so linking this back into the MMT as currency killer thing, what does that say? Well, they're going to say that MMT is going to cause the domestic price of bread, for example, to go up, and then no one's going to want to buy the dollar because the exchange rate is driven entirely in this theory by the purchases of currency to buy bread, you know, to buy goods and services, all right? I was tempted to jump ahead there a little bit, but I'm going to hold on just a second. The exchange rate is driven entirely by the relative prices of goods and services in each country. So, we got 2 countries right here. All right, so here's a country here and one over here. Y'all's bread prices are really high and yours aren't, so your currency depreciates. All right, so you have an MMT policymaker. Oh no, she's in the back right there. She's caused terrible inflation, and so bread's really expensive, and so nobody wants to buy this, you know, your currency, and so your currency collapses, right? So let's see how well this theory holds up. And this is a really, really good book, all right? I teach a class on exchange rates, and back before I had done a lot of my own research on it, I didn't have anything else to teach. I was teaching all neoclassical stuff. And this person's textbook is really good. To use neoclassical jargon, it's rigorous, which means there's lots of math and graphs. And one of the first things that would strike you, okay, I want you to think about if you were taking this class. You've paid, how much is a class at TCU? Oh, I don't know. We got tuition waiver for our daughter. So I am $10,000, whatever a class costs. Let's say $10,000. You've paid $10,000. You're like, oh, wow, I can't wait to learn this. If you were like I was as an undergrad, you're thinking, I'm going to be a rich currency trader. That's what I'm going to do. So I can't wait to learn this single individual theory that must exist about the largest market on the planet. And the first thing you notice in the table of contents is, oh my God, there's 7 theories in here, right? There isn't one theory about the single largest market on the planet that never closes. There's 7 in there. And at the end of every chapter, and this is why I love the book so much, even though I don't agree with it. I love the book so much because at the end of every chapter, he stops and says, well, let's see, how did that one work? All right, let's see how that one worked. And this is what he has in the section on purchasing power parity. We can summarize the evidence by saying that on the face of it, there appears to be no obvious tendency towards purchasing power parity. Well, that sucks, because I just spent a lot of time studying for this exam and thought this was going to be useful. But wait, there's more. And you know the thing about, well, let me jump ahead. But the theory is still sound. We have seen that there are persuasive reasons for supposing that it ought to work. Doggone it, the theory makes sense, you know. But there's, you know, however, the facts, doggone the facts, would appear to provide little support in the short run, and evidence in the long run is at best mildly supportive, all right? So this is from, and yeah, you know, obviously we could get criticisms from people who aren't neoclassicals. This is a neoclassical textbook, all right? And he's surveying the right literature. I mean, that is what the literature says in that area. Also, here's another neoclassical paper. What they did was they surveyed currency dealers, all right? And they discovered that 63% of currency dealers felt that purchasing power parity is merely academic jargon, all right? And even more damning than that, if they, they had a little question in there, okay, what if you found out that, you know, based on purchasing power parity, that the dollar was overvalued? Would you sell dollars? Yeah, about 1 in 10 of them would. But otherwise, they're like, no, this means nothing. All right, so they're the ones actually carrying out the transactions. And oh yeah, of course, this again. They're the ones carrying out the transactions. So you think, you know, I'm sympathetic to what the neoclassicals say about surveys, that people don't always do what they say. Okay, but we're supposed to be scientists and figure out the difference and figure out, you know, and what your justification for your actions is nevertheless interesting. I don't know if you know this or not, but in exchange rate literature, there was a period in the late 80s and through the 90s where there were lots and lots of surveys that they would use, surveys of, if you're a room full of currency dealers, where do you think the euro is going to go a week from now? Where do you think it's going to go a month from now? They would use those data to test various theories. But there would always be an apology in the article. And I know we don't really use surveys, but I didn't have any choice. All right, so please don't, you know, get on me for that, because other disciplines are heavily survey dependent. But neoclassicism is skeptical to the point of we're just not going to look. Oh, I should have put that slide in there. Have you seen the one where if economists were asked to explain the behavior of horses, they wouldn't go and look at horses. They would sit in their offices and think to themselves, what would I do if I were a horse? And this was from a neoclassical economist. It's like, you know, the sort of basic idea of where do I get my premises? Introspection. Right, introspection. I think about, well, let's see, if I was an entrepreneur, what would I do? I had a really nice colleague once who was presenting, not that she's no longer nice, she's just no longer a colleague, that she was presenting a paper on how do high schools decide to have AP classes, advanced placement classes. And she had a regression analysis, and, you know, it was very interesting. And I said, how many administrators did you ask? And she was like, I never thought about that. And she honestly just never thought about the fact that maybe it would be a good idea to actually talk to a superintendent who made this decision. Because what they say and what they do isn't worthwhile. And then that's why we don't bother to look at horses. We just sit in our offices and pretend we're one. Well, I want to show you one more thing from this book, okay? And it's my absolute both favorite and least favorite thing. This is after he's gone over 5 different exchange rate theories. At the end of every one, saying, yeah, that one didn't work. Yeah, that one didn't work. Well, yeah, no, that one didn't work. And I cannot begin to imagine putting this next sentence into a book that students have now spent all this mental energy and physical energy studying. At the end of the next chapter, he says, when it says, how did this theory work? Well, to travel hopefully, it is said, is better than to arrive. This one doesn't work either. It has been in there since this is the 5th edition. It's been in there since the 1st edition, that sentence. And so I've quoted the hell out of it. Sometimes when I quote the hell out of something, that economist takes that out. All right, so there was an econ department somewhere on the West Coast that said, you might be surprised what it takes to go to graduate school, why doing well in economics is not necessarily helpful. And so I quoted that a lot and stuff, and they took it out. So that was that. And then I used to quote this fellow Hans Visser quite a bit, and this was in the early days of the internet. I went into my office, I checked my computer, and there's an email from an H. Visser, and I thought, oh my God. So I didn't even check it. I went and taught my classes and worked up my courage to see what Hans Visser was going to yell at me. Yeah, it turns out he's a nice guy. But he had said something about, and this will actually come up here in a minute, that, you know, well, it could be that exchange rates are driven by things like capital flows and, you know, animal spirits, but then we're left with Keynes, literally, Keynes's gloomy view. Not that it doesn't seem to work, but I don't want to think that. And so what he emailed to me was, you know, well, if I'm a neoclassical, I'm a reluctant one. Okay, but you still are one, huh? So that was an interesting experience. So if purchasing power parity doesn't work, by their own admission, then what should we be doing instead, all right? What should we be looking at instead? So here is the actual volume of trade, according to the World Trade Organization. In 2019, there were $18.9 trillion worth of imports/exports. So if the currency market really is mostly driven by this, like purchasing power parity says, then when I put this next number down here, it should be reasonably close to 18.9. If the market for foreign currency is really just derivative of the market for foreign goods and services, and this is the market for foreign goods and services, then this next number should be reasonably close to 18.9, right? And now, to be fair, there are going to be covering transactions when a bank, you know, undertakes a transaction to finance somebody's imports or exports. I hope I don't break this, but the battery cover's coming off. That's not close. All right, so it's not really very close at all. So there's the actual volume of currency trade. That turns out to be 2.1% of all currency activity is the same size as you know, world trade. And what I was going to say was, you know, to be fair, there may be covering transactions. There may be several transactions related to a single, you know, transaction to finance imports. Let's say there's 10. That's ridiculous. Let's say there's 10. We're still left at 11%. 11% of the market is all we have explained with trade flows. So no wonder purchasing power parity doesn't work. It's ignoring 89% at best. 89% of the market, and probably closer to 98.9. So what should we do instead, all right? And maybe we should look at those capital flows. If we're trying to explain exchange rates, maybe we look at the capital flows instead. And that's me. Oh, see the title of the book? That was her idea. My idea was a post-Keynesian approach to exchange rate determination. She said, that sucks. That's never going to sell anybody. So I went with alliteration, and the funny thing is, she liked the alliteration. I had nothing in the book about crises. So I had to write a whole freaking new chapter because she wanted the title to be good. But it worked out really well. Thank you, Melanie. So if we're going to look at financial flows as being what drives exchange rates, and what I'm trying to point out here is, it's not like there's not an alternative to purchasing power parity. There's other things we can do to explain currency prices that are based on what the activity actually represents. Perhaps we'll look into psychology. You know, this is common in Tversky stuff with availability and representatives and anchoring, that behavioral finance stuff. We talk about if you're a room full of currency dealers and you're thinking about buying or selling the euro, you're basing this on a forecast, right? You're trying to decide which way do I think it's going to go. That is your overriding goal, is to figure out which way do you think it's going to go. And so we have to figure out what's the nature of these expectations, what affects them. And Keynes has some really good things to say in the general theory about things that affect people's forecasts and expectations, sort of the characteristics of them, to where we create a world here where things like panic and euphoria can happen in a way they can't happen in a typical neoclassical model because so many people have all the information and so forth. So you know, they sort of have a psychology background. And then we can do things like this. Again, my point being, it's not like we don't have an alternative. This is supposed to be like, okay, what does the brain of a currency dealer look like? Here's your forecast right here. Here's all the various things that they'll be looking at on their computer screen to just try to feed into, figure out which way it's going to go, and then how that leads to, various things in technical analysis, signals, and so on. We have an alternative, all right? We can then take exchange. This is from Anina Kaltenbrunner at Leeds University. She's done some really interesting stuff with a Minskian currency hierarchical approach to international exchange rates. And so, we get in trouble for you don't have any models. Well, here's one. What the hell? I mean, this is a model of the domestic macroeconomy. It's got Keynes's ZD diagram and the impact of the exchange rate, balance of trade, and so forth. So it's not like we don't have an alternative to purchasing power parity that they say themselves doesn't work. And so at the, you can build a post-Keynesian view of exchange rates that explains all these things that the neoclassical stuff doesn't. All right. So the argument was that, I'm sorry, I'm behind myself. Currency markets are driven by financial, yeah, that's right, I forgot where I was going with that. I've only practiced this like 10 times. Currency markets are driven by financial flows. Financial investors seek higher rates of return. Where would you expect higher rates of return to be? Are we going to expect an MMT job guarantee country to be a place I don't want to invest? Or is it actually going to be a place where, the economy is doing really well there, right? And unemployment's low, presumably GDP growth is high. And so the idea that MMT and a job guarantee would cause a currency to collapse, it might cause it to go up, which is not necessarily a goal, because it makes it more difficult for you to export. But there's no clear indication that, as soon as we adopt these policies, then the currency will collapse. In fact, it might do the opposite if these policies do what we know they will do. So in summary, all right, what was the case against MMT? It causes huge increases in the money supply because adherents believe there are no consequences to this, just like those people at the gas station with all their tires blown out. These increases in the money supply cause inflation, and the inflation means that nobody can buy our stuff, therefore nobody buys our currency. But, as Commander Data will say here in just a moment, I object, right? Because, in fact, money growth doesn't cause inflation, right? And even if we grant that, fiscal policy can, but I don't know if you know any of these people here, but they've already thought about this, and they've said, you know what though, but when the economy is already at full employment, we don't continue to do that, all right? So the idea that everyone's down at the neoclassicals got everybody down at the gas station filling up their tires until they explode, whereas in fact what we're doing is we're going to the gas station where you punch in 32 pounds per square inch, and it doesn't cause terrible inflation, right? And on top of that, currency prices are driven by financial transactions, not trade flows. And the full employment policies of MMT are more likely to create a domestic currency appreciation than a depreciation. And am I done? I have a couple extra slides. Quelle est-il maintenant, s'il vous plaît? I have no idea. I didn't bring my... 220. All right. And so I've been talking for, probably seems like forever to you all, 50 minutes, is that right? Oh, I should shut up then. I'll just show you this real quick. Again, it's my feeling of guilt from thinking that people that aren't formally trained in this might think to themselves, surely neoclassicals don't believe this stuff, all right? And I won't go where it went wrong and how the crisis is they left out the word not. It should be in there, right there. But not changing it. And you may have heard of Paul Romer's paper that came out. He later won the Nobel Prize. Let me tell you about that for a second. So he writes this article attacking neoclassical economics. He's a neoclassical macro, and for reasons that I don't agree with, but I do agree that there are, or let's put it this way, his idea of what we should substitute instead isn't what I would agree with, but nevertheless, and he says we've reached an era of post-real macroeconomics where the modelers don't care if it has any connection whatsoever to the real world anymore, and this is one of theirs. Now, I was on a panel with him after this came out, but before he got the Nobel Prize. I like to think I put him over the top. And I was asking him about it, and he said, oh, I caught hell for this, for writing this. In fact, there's apparently a much more, I guess, stronger version that he took down and put a softer one up. You know why he got in trouble? Nobody said you're wrong. They said, how dare you? How dare you say these things about our revered thinkers? How dare you say something about Milton Friedman? And that goes back to Ron earlier today, talking about the priests. You know, how dare you sacrilege? How can you say this? Yeah, even by our own admission, this stuff doesn't make sense, but nevertheless. Now, have you heard of a book by, it's Colander and Clomer, I think, from like 1990, something like that? They went and they studied PhD econ programs at the supposedly top institutions. And one of the many things they asked them was, they asked them to organize this list here. They said, here's, what would you say is most important to success as an economist? Of all these, qualities here, which one is which one do you really, really, really not see at the bottom? Having a thorough knowledge of the economy, which is exactly where it is, all right? These PhD students from Harvard, MIT, Chicago, when they said to them, what do you think is most important in terms of succeeding as an economist, they put a thorough knowledge of the economy at the bottom. Right? And the thing is, it's not wrong. I mean, okay, and I will shut up here. When you start talking like this, I did stand-up comedy for my senior high school thing, and they had to open the curtains behind me to make me get off the stage because I was having so much fun. So what I don't want is Dimitri or Randy to come in here and drag me out, still trying to talk to you, so I'm going to stop after this. But in my PhD level international trade theory class, highest grade in the class, very proud of myself, all right? And it was all matrix algebra. And I was standing in line at the grocery store not long afterwards. And it suddenly struck me, my God, if everyone else in line here knew I just finished a PhD level course in trade, I wouldn't be able to answer a single question they would logically have. Who's our biggest trading partner? It's either A or B, because those are the only two countries he ever used. What do we import? Either X or Y. That one's easy. Why is our, the industrial heartland, why is it, collapsing? I have no idea. I have no earthly idea. Math is like I like math. I was a physics major to start with. But math for math's sake is like the dark side of the force. It is fun. And it makes you feel better than other people. Ha-ha, you can't figure this out. But it's not the way to do economics. Anyway, merci bien. And again, I got no idea what time it is, so... yes, please. Yes.
Thanks, John. So I have a question on the figure exchange rate. When you say that monetary policy does not cause inflation on its own, therefore it doesn't influence the exchange rate, but you also say that the main determinant of exchange rate fluctuations are capital flows. You could argue that monetary policy does influence capital flows. So how would you answer to people that sort of address that issue?
As a matter of fact, you're exactly right. And there's another session this afternoon where I think Rowan and John and I can't remember who else we're going to be. I thought about bringing it up there. Yes, that's in the brain of the currency market, dealer. That indeed monetary policy can have an effect on my view of whether or not the dollar is a good investment. But the idea that the transmission mechanism is through goods and services is what I'm saying is not true. This area over here of indicators, I didn't know what to do because I was like, okay, well, what are the sort of the biggest determinants of currency prices? And interest rates are number one. Not like, oh, that's 90% of it, but they're sort of the most common. What did Russians do to boost the ruble days after the invasion? They changed the interest rate from 10 to 20%, and guess what? That worked really well. Because like, well, maybe I will take a chance and not cash in my rubles because I'm making 20%. So it's a very powerful mechanism, and that's affected by monetary policy. But it's a different line of causation. And obviously I haven't explained this to you, but this is imports and exports up here, and really and truly, what we do in class is, after I get done setting up the model, I go through like periods of history in the United States and sort of the history of the dollar. And only in the first period, which is after the collapse of the Bretton Woods system, the currency dealers pay any attention whatsoever to trade flows. They just really didn't care. But they do pay attention to monetary policy, but really more in terms of what the rate of return would be.
So just a quick follow-up, because I think that's one of the main issues of MMT frameworks outside of the U.S. Because if you're using deficit, you're issuing local currency debt to finance deficit spending.
Right.
That even if you're using it to acquire real goods that are underneath full employment, that will still influence capital flows, right? So
Yeah, no, you're right. This doesn't mean that trade flows are irrelevant, but it means that the mechanism by which the trade flows end up impacting, the exchange rates really through the financial sector. Yeah. Somebody over here too. Yes, over there in the left corner, and then here, and then Patricia.
Hi, yeah. So yeah, I love the research on international. So I'm curious what you think about envisioning global and northern and southern relationships when it comes to like green development, specifically in cell-based meat and minerals. Because I asked that because I want additionally your take on like how that relationship should look through reciprocity and reconciliation, specifically on credit issuing and zero-rate interest policies.
Yeah, no, this book is, I don't know how many years old now. What you're saying is very important. This is, I think, 2008. And I just here the last year, I emailed the publisher and I said, I need to do a new edition because I don't have stuff like that in there. That when Kaltenbrunner and a couple of other folks, this is about currency hierarchies and the problems that a developing economy has. And I just looked at developed economies, is all I looked at. And so it is a huge gap in what I've set up and tried to figure out. And I don't know. I mean, I would have to sit and think, but it's definitely something that I want to do in the next edition of the book because that's where the answer should be, the important thing. So I'm very sorry. But it's exactly the right thing to talk about. And there was somebody else. Oh, yes. Yeah. Yeah.
Thank you. If we, about full employment and job guarantee, if we take first like goodwill models of the proletariat reserve army, with the full employment, we would have a greater wage share, a smaller profit share, so it might, lead to a flight of capital. So is it possible to have still that kind of process? Would it require, capital controls and stuff like that? And the other question is more like a meta question, but Paul Romer got fired from the World Bank because he criticized the SG models, etc. In my case in France, I was told that if I was keeping Pauline Leontiev production function in my papers, I would never have a job in university. So in terms of strategy for heterodox, what would be your insight? What would be like, how should we act individually and collectively as academics in order to have an impact into higher education and international institutions?
Wow, that's a lot to answer, but I shall try. I've heard my students joke to each other before that if you don't know what else to say on the test, say capital flows. And that's pretty close. And so what we end up with at the end is that if this is the situation, do we need that? Do we need these people, the owners of capital, to be searching around the world for a higher rate of return? Is this helpful? Mexico didn't think so in 1994 when all of a sudden the money's come flying out. So a cornerstone, and let me know what I am not and what I'm not answering you have, but a cornerstone I think has to be capital controls. I don't think it will. Now, strategy, I don't think it will ever happen because the people who are in power gain from this. All right, so I don't know how we do this. I'm hoping that my children and many of you, probably my children's age, will fix the world. One of my colleagues, his daughter said to him, well, we just need you to die. In terms of his generation, not him in particular, because he's a good guy, but his generation, in order to find somebody to fight against this, because these hot money flows are not at all useful. And what individual developing countries need to do are things like capital controls and differential exchange rates. And of course, that discourages money from coming in. But then you have to decide that's okay because it also discourages it from flying out overnight as well. So I don't know how we make it happen. But what can we do? But try. Oh, there's one more over here. I'll get back to you. Patricia.
Yesterday we were talking about peripheral countries and how important the exchange rate is in those contexts. But I'm assuming that the people who have these concerns about the exchange rate are almost in the global north, and what they're really saying is they think there's a relationship between the exchange rate and inflation here. But when Britain left the EU, there was so Brexit happened, there was 20% depreciation of the currency pretty soon. And
Right.
as far as I know, there wasn't 20% inflation.
No, that's right. And you read this. They will literally say, Well, actually, currency prices are much more volatile than the fundamentals, quote unquote, whatever they may be, which, by the way, I have a paper on that from like 20 years ago where I went through all these neoclassical articles. So what did they mean by the fundamentals? And they meant different things by the and yet you would think the very word, fundamental, would imply that these are sort of a solid set of ideas that we all share, and they weren't. But anyway, even by their own admission, even when they don't really define the fundamentals, they say, yeah, there's a lot more volatility. But what do we do when we can't explain the short run? And I don't know how far back it was, but we just look at the long run. We just say, okay, well, it's a long run phenomenon. So, but yeah, they know this. And yes, you had a question in the back, and I'll come back.
Forgive me for everyone else too, if this is a little naive, but there's am I right in thinking that the capital flow or the capital control thing really only applies to the less developed countries? Because when you already have capital development, say in the United States, who cares if the money goes away? We still have the factories.
Right.
We can still make cars. And so the capital flow, the hot money leaving a developing country is more important because they still need the money, supposedly, to build up productive capacity. Yeah. So it doesn't matter to us. Okay, well, the money, we still have the factory.
Right, and we still have our currency too, because what they really want is a hard currency that's at the top of the hierarchy. Ours already is. So it can flow out and flow back in as much as we want, but that's right. I mean, if I've got to import oil, then I need apparently rubles now. But I took a year of Russian in college, and now it might come back. So I'm really excited about that. No, I think that's basically right. Although again, like I was explaining a moment ago, those are things I just never looked into very deeply. You know what else happened when I was finishing up that book? Our department chair called and said, "John, can you take over as department chair?" And I thought, oh crap. So I never really finished the book like I wanted to. So I got to go back and take those into account. But I think that's basically right. Yeah. And yes?
Yes, I also do research in international trade, and I'm from Mexico. And I think it's important to distinguish the difference between developing countries and developed. Because in the short run, it seems that it's very important the capital flows, but also the trade could be important for the long run.
Right. So certainly policy-wise. Yeah. But I guess the difference is that the trade is important in the long run policy-wise, but when we're setting up our model, that doesn't mean we ignore everything but the trade flows in trying to explain the exchange rates. So I think that makes sense too.
Yeah, also the definition in Latin America or in some part of Asia is different. I mean,
right, yeah. See, I took it easy on myself. I just looked at the dollar Deutschmark, which apparently doesn't exist anymore, and I had to change the euro partway through the book. I just did developed economies. You had another question?
Yeah, I have an appetite to at least get something. So I'm curious. This is more maybe a personal one, personal prescription, in my opinion. But I'm curious, like if we just imagine like in a country A, country B, like full-on Green New Deal, like full employment, like things are separated. Do you still see like there's no way out of a way that we can have full sovereignty over full resources in that, even in a world like that? Because maybe even this country wants to focus on space stuff more.
Yeah.
Could there still be that political, moral difference that keeps countries having to trade stuff?
Maybe so. I need Fidel here because every time somebody asks stuff about that, we need to talk to him because he's really thought about this a lot more than I have. And so, I think basically that makes sense that if they have a different set of priorities, and I mean, it's just, it's easy for us to say all this up here, but it's in just as much so for the neoclassicals because but it's hard to put these things actually in place. But that's my job. My job isn't to figure out how to put it in place. I hope I can support people that do that. But all I can come up with is the theories. And that was totally useless. My answer was, but that's yeah. Sorry. Yes.
Hey, quick question. There's obviously been recent spike in global energy and commodity prices and stuff. And on the FX markets, we've seen a weakening in the euro and the Japanese yen relative to the dollar. Can that predominantly be attributed to the fact that, I don't know what the number is, 90% of global commodity trade contracts settle in dollars, and so essentially if the price of those going up, then that's
that increases the demand for it.
using up their dollar reserves?
Yeah, I would think so. You know, the problem with a lot of this stuff is the data are so hard to come by. This, you know, it said it was the, okay, there it is. Sorry. They only do that once every 3 years, this number here. It is so hard to calculate. They check in April, only in April, to find out the total volume of currency trade. So it's very difficult to come up with the numbers, but I think that makes sense. That, yeah, that would be what it would link to. I haven't looked at this side of the, yes, Texan.
I was kind of wondering, do you see the hierarchy of currencies as some people, so I mean, some people kind of conceive that there are hierarchies of currency, like the peso is lower in the hierarchy than the dollar or whatever.
Right.
And some people say that that's sort of maybe what it looks like now, but is artificial. Like, do you think that all currencies could be like strong, stable currencies against each other in some sense, or rather, you know, have that dollar, the thing that we have where exchange rates move and we don't even notice or care? Or is it a thing that only some countries can have at the expense of others?
Well, there definitely is a hierarchy of currencies as exists right now. No question that, you know, geez, I have some money to put into savings, so I want to use dollars or pesos. I'm going to use the dollars. And so that forces Mexico to do certain things to attract the hard currency that they don't want to do otherwise in terms of not having capital controls and having higher interest rates. I don't know. I don't know if my gut feeling is that no, that ultimately there's going to develop a hierarchy of currencies, you know, in some sense. There's going to be, when at the end of the day you have to ask yourself, I have this, you know, international portfolio of assets, and what currency do I want to put it in? If you're going to ask that question, there's going to be a hierarchy, I would think, of some sort. But I may not live long enough to see that because I'm getting older now, and climate change is coming on. So, but
would your choice, I guess, depend on the country you live in and, you know, what you expect to?
What do you mean, your choice of where you are in the hierarchy, or?
Well, you said like when you have a portfolio.
Yeah. That's going to make a difference too. I mean, if I live in Mexico, then yeah, there's no point in not having it in you know, at least some in pesos. But otherwise, yeah. Yes.
Hi. So, I'm coming from political science background.
Me too. I was my undergraduate. Yeah.
I'm happy to hear that I'm not the only one. So, one of the key concepts in international political economy that scholars develop in order to explain the position of the dollar in the international system is the exorbitant privilege.
Oh yeah.
Which is a concept that I haven't heard here so far, and it makes me suspicious because in the IB scholarship, it's a useful way to explain the role that the dollar has in the international currency system and the reason why it has such a dominant position. The fact that the financial system of the US kind of attracts currencies from all over the world, and the US economy has this capacity to issue debt indefinitely, maintaining a hard currency.
Right.
Something similar to a lesser extent is the pound, the British economy with the City of London.
Yeah.
But here in the MMT kind of discursive universe, this concept is not there, and I'm wondering why.
It is, and I don't. To me, okay, I was on Facebook maybe 10, 15 years ago, and Charles, oh good Lord, what's his last name? Hayden says to me, "How long have you been into MMT?" I said, "What is that?" I didn't know what it was because I just thought, well, this is just the proper way to do macro. So when you say in MMT, I'm not really. I just think there's stuff that makes sense and stuff that doesn't, and I don't really end up trying to draw a line anywhere. And this stuff from, I'm going the wrong direction. This stuff from Anina Kaltenbrunner and others, that is exactly what these articles are about. Talking about, you notice that the dollar has one less variable next to it. It's because it's the dominant currency. So they do talk about it there, but they're not really talking about MMT because they're like, okay, we need to figure out the way the exchange rate works, you know, independent of all these other factors, and then you can plug that back in and see how it works. But I think that probably Eileen Grable has written on this. She does some really good development stuff, and this is Anina Kaltenbrunner and God, a couple of Brazilian guys whose name I can't think of right now. So I just wouldn't necessarily think of it as MMT per se, but you know. hey, we're all under the same tent because we're all people who are worried about the same problem in the world and are trying to be realistic about the way to solve it. So, but I think it's there.
One more question.
Yeah.
So, a key aspect from the exchange markets is expectation.
Right.
So, do you think that with capital control we can minimize this expectations that flows to the undeveloped countries? Because historically, the financial markets innovate itself very quickly, especially in underdeveloped countries.
Right.
So, can capital control be enough to control these expectations around the world?
Right.
Because we are seeking for the free employment program, this can be an aspect that can manipulate the expectation from the rich countries and the market itself. So it's my question to you. Do you think that capital control is enough?
Not static ones, because I mean that's what I've seen. You know, because I was trained as a neoclassical, like almost everybody is, but then I found the post-Keynesian stuff. I was like, oh my God, now I do want to finish my PhD. And from the beginning, with Minsky on up, it's like, no, they're always going to innovate. They're always going to find ways to go around. So it must be active and discretionary. You must be able to make changes sort of on the move. So otherwise, you're absolutely right. They'll figure out a way around it because they have every reason to. So, but I don't know. You know, depends on the circumstances, of course. Eileen Grable talks about having speed bumps and tripwires to indicate that there are problems evolving. For example, one of the tripwires would be, what is the ratio in this country of loans taken out in foreign currency versus domestic currency? As that goes up, this economy is more unstable. It's more likely to have a, if there's a currency collapse, and short-term versus long-term loans and so forth. So if you have things like that, and then the speed bumps sort of slow down, the capital outflow. And I think if you have things like that in place, then maybe you can do enough of the discretionary stuff to say, oh my God, there's a problem. Clearly we haven't fixed all this like we thought we had. But you're absolutely right that you have to continue to do it.
Thank you very, very much.
Thank you.